So I'm absolutely honored to have Matthew McLennan here with us today. Matthew McLennan is a co-head of the Global Value team and the portfolio manager of the First Eagle Global Value, International Value, US Value, and Gold strategies. He joined First Eagle in September 2008 to lead the Global Value team. Previously, Mr. McLennan worked for Goldman Sachs Asset Management in London, where he served as the co-portfolio manager of Global Equity Partners, a group he co-founded in 2003 that ran a focused global equity portfolio for offshore private wealth clients. Earlier in his career, Mr. McLennan was Equity Chief Investment Officer of the Investment Strategy Group for Goldman Sachs Private Clients business. He joined Goldman Sachs in Sydney in 1994. Mr. McLennan started his career in 1991 in Brisbane, Australia, with the Queensland Investment Corporation, and was ultimately responsible for the firm's international equity exposure. He was born in Rabaul, Papua New Guinea, and grew up in Queensland, Australia. He received his Bachelor of Commerce with first-class honors and Master of International Commercial Law from the University of Queensland. Mr. McLennan also holds the CFA designation. Thank you for joining us today, Mr. McLennan.
It's really a pleasure. Thanks for having me. Let me just sort of kick off by talking about our mindset at First Eagle, because I think that's critical to understand. And we're a little different from most investors in that we truly invest over a decade horizon, and we have a very clear sense of true north, and we refer to it as a resilient wealth creation mindset. And you can see it clearly in our low portfolio turnover ratio of about 10%, and in our historical risk return character, which has sound compound real returns and typically lower than market drawdowns in windows of crisis. And if I could give you an analogy, I think we're a little bit more akin to prudent and patient business gardeners. We look to plant investment seeds. We hope they'll bear fruit and grow, but we also know that the seeds that we plant will face all weather conditions. And so, when we approach the task of investing, we think very much like business owners, and we have a time horizon that's frankly longer than most private equity players, even though we operate in public markets. And so I think it's worth delving in a little bit to talk about what we mean by resilient wealth creation. And I'd like to start with the second part of that term first, wealth creation. And when I think about wealth creation over full business cycles, it really requires us to be primarily owners of stably positioned, cash flow generative, well-run businesses, some that grow, some that are more mature. But this requires the active determination of businesses that either have the benefit of incumbent, well-located real assets in competitive markets, or businesses that are entrenched within less competitive niche industries. And so by definition, a pillar of wealth creation is business selectivity. And I would say that a margin of safety and price is also critical. We want to see a path to free cash flow yields on our investments sufficient to compensate us for permanent impairment risk. And when you think about why investments fail over time, it usually comes from one of three key reasons. It could be generational business model fade, it could be medium-term business cycle downside, or it could be management agency issues and dilutive management behavior. And so, we look for a free cash flow yield that's going to compensate us for those hard to diversify risks. And sometimes free cash flow capacity is concealed by a company's advantaged reinvestment. And we will give a common sense nod to the current pace of value creation if there is apparent latency in the real assets or the market position of a good business. But whether it's a near double-digit normalized earnings yield for a prime player in a competitive industry, or a mid-single-digit free cash flow yield with mid-single-digit growth rates for value creation for a compounding franchise, we like to see the line of sight to high single-digit, low double-digit returns, depending on the risk character of the business before we commit capital. And so that's the essence of wealth creation for us. On the resilience side, I'd like to sort of parse that term into long-term and medium-term elements. Over the long term, resilience requires satisfactory real returns. The goal of investing over the long term is to really preserve and grow your purchasing power relative to what is a rising nominal tide of GDP. And given that goal long term, resilience is fundamentally intertwined with wealth creation. However, in the medium term, within the business cycle, if you will, resilience requires the delivery of an element of downside mitigation in crisis. One of the things that we've learned is important is that you want to keep people with you on the compounding journey. And so what you don't want to do is to be more volatile on the downside in times of crises, because people behaviorally tend to sell at the worst time. And to produce that downside cushion, if you will, for us really comes from three factors. The first is our stock selection approach, and I'm going to detail that in a few minutes. But it's an important part of the process. And what we're trying to do in our stock selection approach is avoid overpaying for optionality in the universe of either speculative businesses or more marginal businesses. The second thing that we do differently that helps in terms of resilience is that we don't force all our money to work at any one point in time if we don't see the right opportunity at the right price. Thus, we tend to have some residual cash, and that helps both cushion and take advantage of crisis. And thirdly, we maintain a bit of a hedge for our business investments in gold. And when I think about our focus on resilient wealth creation, it's a very different mindset from many investors who focus on tracking error risk. We have what we've referred to as a high active share approach. We focus on avoiding the permanent impairment of capital, one security at a time, as opposed to trying to minimize short-term deviations from market returns. And when we think about the focus on business selectivity and a margin of safety and price, and having some portfolio ballast in cash and gold, we think that's important for the world that's going to be coming in the next decade. I have a hunch that the best returns to just naively owning stocks are in the rear vision mirror. The last decade has been good for the passive ownership of stocks. But now we see high valuations in most risk markets. We see elevated sovereign debt levels and the associated policy risk with that. We see an element of geopolitical risk. And we've already experienced a number of man-made risks from climate change to pandemics in recent years. And so I think it's important to be thinking about the notion of resilience in investing, because just being exposed to risk may not be as attractive going forward, given how high valuations are and how tight credit spreads are. So I want to dive a little bit deeper into the pillars of how we generate our real returns, because I think that's an important thing to understand. And there's really four key sources for us in our portfolios. The first is the margin of safety approach to stock selection, which we'll go through in more detail. The second is our countercyclical deployment of cash. The third is the choice of gold as a potential hedge. And then the fourth is prudent currency hedging. And I just want to touch on each of these briefly before we go to the Q&A. From a stock selection standpoint, I just point out up front that our margin of safety approach is not about deep value nor simple statistical value, as this often leads one to adverse selection risk with weaker businesses. And when you buy a weak business, it's akin to buying an out-of-the-money turnaround option. Rather, we think of, as long-term business owners, we've got to focus first on the scarcity of incumbent assets and market position. And we're then sensitive to price and management behavior. So while we'll give a common sense nod to the latent value inherent incumbent real assets or market position, we don't get carried away in concept stocks, which are expensive call options on the future either. So if you picture a tennis court here, we don't go into the doubles lanes of the tennis court, if you will. We stick to the singles court, cash flow generative businesses, where we have line of sight to value creation, and we're trying to avoid the most option-based businesses at the fringes of the tennis court, if you will, either turnaround stories on one side or concept stocks on the others that are really call options on the future. And it is fair to say that we always start with the documents. We assess the margins, the cash flow, and the balance sheet evolution over time to get a sense for the character of a business. and the capital structure risk. But we recognize in our approach that there are important intangible assets, such as market position and management acumen, that are not well represented by GAAP financials. And intangible assets are the key drivers of future cash flows and longer term compounding. And so we spend a lot of time thinking about intangible assets. And I think you already have a sense for this from my preliminary remarks, but a key intangible asset that we seek out is business scarcity value. And when we talk about business scarcity value, we mean businesses that benefit from some kind of incumbency. And that is either well-located, long-duration real assets that are advantaged in one form or another, or high and entrenched market share. And these kinds of businesses are inherently resilient and persistent, not only because of the duration of their assets or their market share position, but because of their superior margins and cash flow generating capacity, which help cushion cycles and which provide for business reinvestment optionality. Companies that have scarcity value in their incumbent assets or their market position also tend to have earnings power that can grow at a measured pace over time as management avails themselves of advantaged brownfield or concentric reinvestment opportunities in the business. And the second intangible we focus on, because if you've identified a business that has cash flow generating capacity, is you want to align yourself with the right kind of stewards of that cash flow. And we very much favor family and founder shareholders or strong cultures of equity ownership in the companies that we invest in. We like management teams who protect their core competitive advantage, who focus on efficiency, and who expand prudently in concentric circles around the core. We like managers who pay healthy dividends, but who don't push the capital structure to its limit. We like managers who are willing to deploy capital countercyclically, be it with CapEx, bolt-on M&A, or repurchases. So the management acumen matters a lot. And once we've identified the character of a business by looking at its history alongside the scarcity value of its tangible and intangible assets, we then shift our attention to whether the price is sufficiently modest to provide for a margin of safety. Obviously, we like it when the enterprise value of a company is at a discount to private market M&A multiples. But we also like the arithmetic to make sense. We like it when the sustainable free cash flow yield is close to or even above the real cost of capital. So we're getting the latent business potential for a very modest price. We will bend a little on the free cash flow yield if we have a direct line of sight to value creation today. But in short, we like to feel that we're liquidity providers at a moment of either market uncertainty or business neglect, and that we're not just chasing turnarounds or glamour stocks. Mundane for us can be quite beautiful, actually. And if you think about our analysts, they have a wish list of companies that they'd like to be owners of, and they wait. We can wait up to a decade to buy a business, and then we'll often own it for a decade. And I'll just make a point on ESG, because I know that's a very important topic at the moment. And that is that sustainability and stewardship are important to what we do, because we're seeking out businesses that aren't just scarce, but that are persistent. And as fiduciaries, we also need to weigh the impact of governance, environmental, or social risks against the price we pay. And this is an important point. We don't put blanket bans on securities just because they exist in so-called sin sectors. A stable or even modestly fading business can afford an equal investment opportunity to a growth story if it's bought with the right price with a sound management team. And so just as we would seek to identify positive intangible assets, we have to symmetrically be attuned to contingent liability risk through environmental, social, or governance factors. One thing I would say, though, is that good management teams are adaptive. They can improve sustainability. They can steward existing cash flows thoughtfully and accretively. They can improve a difficult environmental or social inheritance. So governance is crucial for us. As a team, we do about 1,000 company visits a year. And if I could summarize our approach to sustainability, we adopt a value, not a values-based approach to sustainability. A company that's focused on stewardship that's good to its employees and seeks social license in its communities, and is improving its resilience to climate change or carbon emissions, can create long-term value, even if starting from a less than perfect position on any of these variables. And that's important. We have to be open to constructive change. On the cash side of things, a fundamental pillar of our approach is that we don't have to force the cash to work unless we feel we have a margin of safety. So the buys and sells don't always net out. Our cash levels are therefore a residual of the buy and sell discipline, and that's important. And what we have to do is weigh the optionality of getting an attractive business at a potential future discount relative to the foregone participation in nominal growth while we wait in cash. And given this balance, we don't tend to carry more than a year or two of deferred purchasing power in cash. And given our 10% portfolio turnover rate, that typically means that our cash levels average about 10%. In frothy markets, they tend to peak out at around 20%. And when things get into distress, we tend to look more fully invested, like during COVID last year or in the first quarter of 2009. I want to spend a minute talking about gold. Because we're primarily a patient owner of business in what is a far from perfect world, and because we don't like to hold excessive cash balances, we do want a potential hedge that can also serve as a longer-term counter-cyclical store of value. And the low yields on sovereign bonds relative to money supply growth and the high cost of market put options means that we've actually had a preference for owning a diversifying real asset as a potential hedge rather than using a financial asset as a potential hedge. And gold is unique amongst the universe of real assets because it's inherently scarce, like the businesses that we target, and it's thus served as a store of value. It doesn't have a yield, but it doesn't have fade risk. It's chemically inert, so it actually pretty much lasts forever. It doesn't have business cycle risk, and it doesn't have management dilution risk. So it doesn't have all the kinds of risks that you would otherwise need a free cash flow yield for. And despite its absence of yield, it has had a sound long-term return from price appreciation. As its absolute scarcity, it's remained relatively static in terms of the per capita supply of gold over the last 50 years. Because of its scarcity, it's actually outperformed the nominal GDP growth over the last 50 years, and it's outperformed the returns on sovereign cash in all the major currencies. And so it's a bit of a paradox. People say, why do you own gold that doesn't have a return? Well, actually it does. And I think the way to think about it is as something that's akin to a prime but undeveloped piece of land in a growing neighborhood. As the neighborhood accretes in value, so does that vacant lot of land, even though it's not yielding anything today. And what's important about gold, though, is because it's chemically inert, unlike commercial land or other commodities, its price is not primarily dependent on the health of the economy. In fact, as real interest rates go down, be it in deflationary or inflationary moments, the real value of gold tends to appreciate, thus its hedge character. Gold has also tended to have its valuation peaks when risk assets are depressed, such as after the oil shocks in the mid-70s and early 80s, and likewise in the wake of the global financial crisis. Also, gold tends to be depressed when risk appetite is high, such as the late 60s, the late 1990s, or frankly now, gold is pretty depressed. Not only has gold's risk character been what we've sought as a potential hedge, but over the past 50 years, as I mentioned, gold has outperformed nominal growth and sovereign cash. And it's done so because gold's supply growth has been less than money supply growth. And moreover, real rates on sovereign debt have structurally gone down as the quality of sovereign debt has eroded. And I think the secular erosion of the quality of sovereign debt is actually common sense. Once we remove the constraint of the currency having an exogenous link to gold, monetary creation became more endogenously linked to the perceived and surprisingly recurring need for policy accommodation. And so, gold is an important potential hedge for us, and therefore our commitment to it is more strategic than to our cash, which is a residual of our buys and sells. So the cash will go up and down through the business cycle for us, whereas the gold is a more strategic holding. Think of it like a bank would think of its tier 1 capital. And you probably only see us exit gold in a truly bad state of the world where we'd already invested all of our cash and we saw wonderful business opportunities at highly discounted prices. So think a very long-term depression or a very great recession, not an ordinary recession. And the final thing I'll just mention is, as global investors, we can't avoid the currency decision, right? And so, when we find a cheap stock in a foreign country, we have to make a decision about whether we want the currency exposure or not. Now, many investors are pretty dogmatic about currency. They either choose to hedge all of the time or to be unhedged. But we take the same value mindset to currency that we would to anything else. And so if we found a cheap stock in a currency regime where the currency is expensive in real terms relative to where it's traded over the last couple of decades, and we can't explain that premium valuation for the currency by reference to either current account differentials on the trade side or capital account differentials in terms of real interest rate differentials, then we'll hedge out of prudence. On the other hand, sometimes you're paid to diversify. Sometimes currencies are cheap in real terms relative to history. And sometimes that cheapness is not explained by poor trade fundamentals or large negative interest rate differentials. And so we're willing to be unhedged in those circumstances. And so I would describe our approach to currency as long-term value-based and fundamental-based. Most currency traders are quite short-term in trying to predict fundamental surprise or policy surprise, whereas we look at longer-term valuation of the currency in real terms and weigh it against trade and real interest rate imbalances. Before I go to the Q&A, I just want to make a couple of concluding remarks on a very important topic, which I refer to as temperament. If you had to ask me what our key competitive advantage in capital deployment is, it's our temperament, not a forecasting crystal ball. And I think there are three elements to the temperament that we really value. One is humility. We have an abiding respect for uncertainty at First Eagle. Top down, we tend to take advantage of market moves after the fact rather than trying to predict them. Bottom up, we seek a margin of safety in each security that we buy, both in terms of business character and price paid, rather than just looking at beta or factor exposures. And we're also not blindly contrarian. When the fundamentals disappoint on relative to our underwriting expectations, sometimes we sit back and we reassess. We might even sell a position. The second element of temperament that's important is flexibility. We have a willingness to look globally for both diversification and selectivity. And we have a willingness to hold cash and gold as ballast. And so mental flexibility is very important. And the final, and I think most important attribute of our approach is patience. And I think you have a sense for that from our low turnover. But as I said before at the beginning, we're much more like business gardeners, and we take a decade horizon as business owners. Our stock selection value add comes from long cycle elements, be it valuation improvement that plays out over many years, or the gradual lift in intrinsic value from the latency inherent in strong market positions, or the gradual accretion from sensible management actions, or the episodic opportunity at a portfolio level to capitalize on business cycle crises. The cash flexibility gives us the ability to be patient buyers, and owning the potential hedge in gold allows us to be patient sellers because we're not having to worry about when to take risk off. And I think the key thing I wanted to get across here is that with the right temperament, volatility becomes your friend, not your enemy. It is the source of margin of safety opportunities. And so let me sort of stop there because I don't want to risk speaking for too long when I know you've put a lot of time and energy into some great questions. And so maybe we can transition to the questions if that makes sense.
Yeah, thank you so much for discussing your framework. I think that'll be very, very helpful for us to reflect on and help us to become better investors as well. And can we return for a second to discuss what you were discussing, where you're meeting a lot with management of companies? What are the key questions they typically find yourself asking management?
Well, the first thing I'd sort of say with management meetings is before you even do one, I'd focus on the documents first. It really helps to be prepared before a management meeting. And I think you can do a lot of groundwork trying to understand the character of the accounts in terms of revenue recognitions, accrual accounting policies, any changes in accounting policy changes, whether there's been serial restructuring provisions, legal contingencies. Just reading the audit opinion is important, and people often forget to do that. Often you pick up really interesting things. But other things that we would look at is, related party transactions or non-contiguous reporting periods for subsidiaries. So just a close review of the accounts first before you meet with management will give you some sense of the character of management. I also think it's useful just like reading the CEO and the chairman's letter in the annual report, because the tone with which they communicate to their shareholders is important. Are they communicating in grandiose terms, or are they down to brass tacks, talking about the cash flows of the business and what's going on, and talking realistically about the business? I think you get a lot of character. So I'd like to sort of sum up the character of management before I even meet with them. And then when I meet with them, I'm not looking for insights on the quarter. It's not like a hedge fund, because we're looking to be business owners for the next decade. So it's much more important for me to see if my assessment of character from the numbers is consistent with the people that I'm meeting. And I think one of the things that's tricky is that people often have management meetings because they're trying to get advantage perspective on where a business is going in the near term. But you got to remember that senior managers are typically the best salespeople, and they can tell you one of three things. They can tell you the truth, they can lie, or they can tell you what they think is the truth, but they might be wrong. They could be biased or just not have the right facts. And so, but whatever they're telling you, they're going to tell it to you with passion and conviction, and they're going to be pretty persuasive, because they didn't rise to be a CEO, without that kind of sales ability. So I think that whenever I meet with the management team, I almost like a cooling off period for a week or so after, just to let the dust settle in my mind, so I'm not too enthusiastic one way or the other. But what are we looking for? We're typically looking for managements that are focused on the core operations. They know what their competitive advantage is. They can speak about the business in granular terms. They're focused on their key competitors. They're looking to exploit their scale advantages. They're expanding in a measured way in concentric circles around where they're advantaged. They're paying good dividends. What we're looking to avoid is the grandiose B-grade banker types, who've got a story but aren't in touch with the details. And I think we spend a fair amount of time also talking about M&A that they've done, or how they think about stock repurchase, to see how they're thinking about allocating capital. We like to explore situations where the free cash flow story tells a different story from the pro forma reported earnings. And so those are some of the things that we prepare for and look for in management meetings.
Yeah, that makes a lot of sense. Thank you. And what are your thoughts on foreign shareholders recently being able to oust Toshiba's chairman and make new appointments to the company's board? Do you believe that we're entering into a new era of corporate governance in Japan, where foreign shareholders have increasing influence on corporations, and public companies will reduce the excess cash on their balance sheet, paying it out as dividends and buybacks?
It's interesting. Japan is a market that we've been in for a long time. At one point we may have been the largest foreign investor in Japan. Japan is a culture that has a lot of appeals to us, because the patience is highly valued in Japan. And people, I think, sometimes wrongly stereotype the Japanese as being unreceptive to non-Japanese ideas. But it's interesting, if you go to the Meiji Shrine in Tokyo, you can see the emperor was a fan of Burgundy wine, and there are these Burgundy vats by the shrine. And so I think in Japan, the metaphysics of quality is a very important kind of philosophical notion. And so I think the Japanese have always been open to good ideas, but quality matters a lot. And there hasn't been a great receptivity to the hedge fund managers who will just show up one day and mount a negative PR campaign and tell you to raise prices and distribute cash and the like, because they know those shareholders are often going to be gone in 3 to 6 months. And there's a natural tendency to think about who are the stakeholders who are going to be with you for the next decade. Long-term shareholders, your key employees, your customers. And so stakeholder balance is very important in Japanese corporate governance. And we've often found that soft influence works a lot better than shaking the tree, in Japan. But I will say that, if you look at the history of Japan, there's been a history of collective adaptation to different forms of scarcity. I mean, Japan didn't really have a lot of arable land for agriculture, yet they became very productive. Japan was highly exposed to the oil shocks in the 1970s because they don't have a lot of their own energy supply. But they adapted, and they have half the consumption of oil per capita as the US. You saw it in the wake of Fukushima, where the Japanese had to adapt to power grid outages. And I think increasingly what we're seeing and hearing from companies in Japan is that they're starting to treat capital as a scarce resource. And there is a focus on increasing ROEs, distributing cash flow. And so we've seen many companies pivot towards distributing more of their surplus cash flow in the absence of noisy hedge fund investors having to come in and shake the tree.
Yeah, absolutely. Thank you for that commentary. And you have some investments right now in the semiconductor space. What do you recommend? What are some resources that you recommend for interested investors to learn more about that space?
Well, I think in any space, and I think semiconductor space is very important, the first thing that we look for before we even start to think about growth rates is persistence in market share. And this is particularly important in industries that are rapidly changing, because growth only creates sustainable intrinsic value if you've kind of got a lock on a market. And so in the semiconductor industry, we've tended to zero in on companies that have displayed strong and stable market share positions over a sustained period of time. And that's led us to different parts of the semiconductor supply chain. Our largest investment today is in the semiconductor fabrication space, the foundry business, Taiwan Semi, where they've had near 50% market share for the better part of the last generation, and there's enormous scale benefits to that business in terms of R&D and process know-how. And in some ways, it doesn't matter who creates the next great semiconductor. Someone like a Taiwan Semi needs to make it. So whether it's an ASIC for Bitmain for Bitcoin mining, or whether it's an ASIC for an industrial application, or some other logic device, for a specialized microprocessor, you don't have to pick the winning company necessarily. You can pick the company that makes the semiconductors. And we've also focused on a niche of the semiconductor industry, which is the analog devices, and these are chips that essentially convert real-world data to digital signals. And the simple insight here is that as technology proliferates beyond the PC and the cell phone to the factory floor and to the farm and to the automobile, there's an exponential growth in the real-world data signals that need to be picked up. And it's a very stable industry with a couple of dominant players. And the product life cycle tends to be much longer than for consumer applications. And so this has been a very attractive niche industry for us to focus on. We were invested historically in field programmable gate arrays, but those companies have been acquired. And so I think the key, though, for us, if I could distill it, was to try and identify niches within the semiconductor industry where market shares were strong and stable. And there's cyclicality in that business, but if you own advantaged players, you can ride those cycles out over the long term.
Yeah, that's a really insightful approach. Thank you for that. And you're discussing some of the macroeconomic uncertainty that you see ahead earlier. If the dollar does lose its global reserve status, what do you believe will be the new currency that replaces it?
It's a tough question, because currencies are a relative beauty show, and unfortunately, there's a lot of ugly ducklings out there right now. Look, I think the euro has some merits. If you think about the euro objectively, it has had a history of lower inflation than the United States. There's been lower money supply growth in the Eurozone than in the United States. There are lower fiscal deficits in the Eurozone than there are in the United States. The US runs a current account deficit, whereas the Eurozone as a whole runs a trade surplus or a current account surplus. The Eurozone has a larger population than the United States. But there's some problems with the Euro. It's an incomplete fiscal union. It doesn't have a kind of cohesive deposit insurance scheme across the entire Eurozone. The labor market's not as flexible. If you get laid off in Italy, it's hard to just go and pick up and move to Germany. And so it's not perfect. Japan and the UK typically feature in some of the reserve mixes, but they're smaller economies. And so they couldn't really serve as a sort of dominant monetary reserve currency. China is a potential contender, but its markets aren't fully open. And it's not a democracy, and it's had much more rapid money supply growth over the years than the United States, and it's arguably over-levered relative to its stage in industrial development. But I think the broader point that I'd like to make is that the whole notion of any single currency being a dominant reserve asset is an economically flawed idea, because if you have the majority of countries running trade surpluses to accumulate foreign currency reserves, and you have one reserve standard, it means that that country has to run a large current account deficit, symmetrically. And that means that that currency will be on a depreciation trend over time. And so the paradox of identifying a single reserve currency is that it'll wind up being a depreciating currency over time. So I think if countries want to accumulate currency reserves, they'd be better off accumulating a basket of currencies that sort of mirrors the world economy, almost closer to, say, like an SDR or something like that, or to do something that's exogenous to the system, like gold. And and then there's those that would say, well, maybe Bitcoin is going to be a digital form of monetary reserve at some point in the future. So I think the idea of a single reserve currency is a flawed economic system. And we are going to see the consequences of that in coming decades.
Wow, that's a really fascinating way to think about it. And how do you assess long-term investments in industries like tobacco, oil, or natural gas that may face declining long-term demand trends and increased future regulation?
Yeah, so it's an interesting question, because some people reflexively want to avoid an industry that they feel has some taint to it. But sometimes that taint is also equally dissuades competitors from coming into the industry. And so, tobacco is an interesting example where volumes have been declining a couple of percentage points a year for quite a long time. And there's been an absence of new entrants to that industry. But the companies have managed that fade exceptionally well. Over time, equilibrium pricing has gone up because the price elasticity of demand is very low. And so, in a sense, managements have an adaptive strategy that's helping transition from harmful forms of nicotine consumption, such as smoking, to arguably less harmful forms of nicotine consumption. Whether it's oral products or heat not burn or vaping products. And so what's happening is, as the companies are raising prices on combustible cigarettes, those volumes are shrinking, and governments are raising taxes on combustible cigarettes. So governments have a sort of vested interest in that tax stream being in place for a period of time. And so the fade rate of that industry is happening, but it's happening slowly, and the companies are growing profits because pricing is rising faster than volumes are falling, and the management teams are making their products better and healthier, and so they're adapting, so that they're going to make their products more sustainable. Like in some ways, we're all at peace with having an espresso in the morning or a cappuccino. Caffeine is a drug. Sugar is like a drug, and now many states are sort of legalizing cannabis, right, and marijuana. Yet many people have that in a kind of harmful combustible format that's less regulated than the nicotine industry. And so there's a lot of paradox out there. And so I think, as an investor, you have to be open-minded to the fact that these companies exist. They're trying to make themselves better. And you have to weigh their free cash flow and their actual earnings growth against some of those headwinds. And the same in the oil and gas business. I think one thing's pretty clear, and that is that the price of energy is going to go up in the next decade, either because of underinvestment in converting resources to producing reserves. Yes, over time, we're going to move more of the fleet of cars to electric vehicles, but that might affect 20% of the oil market. But there's also a structural demand for hydrocarbons that are in everyday things, the screens that you might see in electronic devices, or some of the componentry, specialty lubricants, for example, for industrial purposes. It's very hard to move away from jet aviation fuel because of the energy density. And so a bit like the tobacco discussion, the fade curve in energy transitions tends to be quite slow. And I think there will be measures to try and accelerate that, from regulations and subsidies for alternative energies to carbon taxes. And what I think it means is that the price of energy is going to be going up in one form or another. And so you have to be open-minded when you own a portfolio to potentially having a hedge against that risk, because oil is the most consumed commodity on the planet. If we have a shortage of it because people are afraid to invest in energy, then that's going to affect the health of the global system. So I think we're going to see a transition over time to cleaner forms of energy, but it's going to take time. And meanwhile, there are companies that are in that industry, like the tobacco discussion, that are part of the solution. The world leader in carbon capture technology is ExxonMobil, right? Some of the companies that have historically had the rigs, the components that are used to build offshore rigs, have the expertise to build offshore wind farms, right? And so sometimes the owners of the solutions to the problem are the companies that have incumbency in that industry and expertise. And so they shouldn't necessarily be dismissed out of hand. And so I'd say each situation is kind of a nuanced judgment, one at a time.
Yeah, thank you. That's very interesting. And can you also discuss what's your framework for analyzing pharmaceutical companies?
So yeah, we have a bit of an unusual framework for pharmaceuticals. A lot of people spend their time trying to predict what they think are going to be the next great drugs that come onto the market, and they're looking to buy that optionality. We have a bit of a different approach. We look at pharmaceuticals almost as if they were a mine. You have a certain number of patented molecules, and you have a certain remaining life for those patents. And just like a mine depletes naturally over time, those molecule patents are going to roll off over time. And so what we do when we look at a pharmaceutical company is we think about the runoff value of its existing molecules in the marketplace, the same way you'd look at the valuing the production of a mine. And typically we've invested in the space where we've identified companies that we like at times when they're at a discount to that runoff value. So we're not paying anything for the R&D optionality. And that's really important. And often we've focused on companies that have other ancillary businesses that may be more stable cash flow generative businesses, such as the consumer over-the-counter healthcare business, whether it's selling headache tablets or toothpaste or things that you'd buy at the drugstore, basically. That's a very stable cash flow generative consumer staple business that often gets housed within the pharmaceutical companies. Or the vaccine business, is a much longer duration business because you're dealing with big molecules that are harder from a process control standpoint to mimic, and where you have specialty expertise. So, it's a combination of looking at the runoff of the existing molecules, not wanting to pay for the R&D optionality and get it for free, and then looking for ancillary businesses that are stable sources of cash flow generating capacity.
Yeah, thank you for discussing your approach on that. That's very helpful. And then also, how do you look at banks and insurance companies?
So the key with banks and insurance companies is to focus on companies that have advantage market position. So if we're focusing on a bank, we like banks that have strong local market deposit share. Banking is inherently a local business. Many banks try to be big in their footprint and widely dispersed, but they end up lending to large corporates at very narrow net interest margins. Companies that have high local market deposit shares tend to lend at high net interest margins and tend to have greater scale economies in their fixed costs. So they tend to have more cash flow generation and therefore more resilience against inevitable credit crises and a better understanding of their clients and therefore better underwriting. But we also look, like the pharmaceutical companies, for sources of non-balance sheet related income, whether it's recurring fees from credit card merchant acquiring or insurance brokerage or other things. We love fee income streams that exist independent of the balance sheet. So those are some of the things that we would look for. As it would relate to insurance companies, insurance business is an interesting one in that if you get paid the premiums in advance, if you have an advantaged market position in a niche of the insurance business and you can underwrite profitably, it's essentially like being lent money at zero cost. In fact, you have an underwriting profit. And so for insurance companies, we want to make sure that they have a strong market position. If you don't, essentially you often run at an underwriting loss because you're getting investment gains on the premiums that you've received in advance. But if you're strong in a certain niche of the insurance market, you have the ability to make a profit and get the economic value of the investment portfolio you own. And many insurance companies trade at a discount to the investment assets that they own. Yet as a shareholder, you're essentially getting the post-tax economics of that portfolio plus the underwriting spread. And so we focus on companies that have a history of profitable underwriting because their float is valuable, and particularly those that have investment acumen on top of that.
Yeah, that makes a lot of sense. Thank you for that. And throughout your career, what were some pivotal financial and economic events that changed the way that you think about investing?
Well, there's been a lot, and you get taught different lessons at different points in time. I remember reading a book by George Soros many years ago where he talked about the notion of reflexivity, and that notion became real to me in the late 1990s because I saw a range of overvalued companies that actually were able to use their expensive stock to acquire more real businesses, and they weren't limited by their retained earnings to growth. So when you learn the Gordon growth formula, it's all about retained earnings. But if you have an overvalued currency, that gives you some extra optionality. And likewise, there are some other companies that had depressed currencies or depressed equity values, and they were limited to the retained earnings growth. And so reflexivity is important. Like there's an interplay between perception and reality. I learned that lesson in the late 90s. Another lesson I learned back in the late 90s was I was worried about the market valuation level. So I personally bought put options on the S&P 500 in late 1999. And it turned out the market did crash sometime later, but my put options had expired a month or two before that happened. And so the time, a key thing when you're buying options is that you have to be right on timing. And I think it's very hard to be right on timing. And that's why we've opted for a more strategic potential hedge like gold rather than trying to be too cute with the timing. I think another lesson learned in the early 2000s is, if you're looking to buy a good business that has endogenous integrity, you're going to have to be comfortable often doing it at a time of exogenous uncertainty. And I remember, one of my bigger holdings back then was McDonald's in 2003. And it was around the time where you had fears over mad cow disease and, the Super Size Me movie came out and whatnot. But at the end of the day, they were able to adapt their business and they had a strength of market position. And it's just like when Buffett got involved with Coca-Cola during the Pepsi challenge. Sometimes if you've identified a business that has staying power, what's going to afford you the opportunity to buy a good business at a good price is some kind of exogenous uncertainty, which is very different from an endogenous problem. I think the global financial crisis taught us some valuable lessons. It's a reminder that if you're a shareholder, you're a residual claimant on the business. If a company doesn't have a good capital structure, the debt holders might end up owning those assets. And so capital structure matters. And I think more recently, whether it was a global financial crisis volatility or some of the volatility that we saw around COVID, or even some of the newer asset classes like Bitcoin and the related cryptocurrencies, I think we get reminded time and time again that financial assets are not normally distributed. They're distributed on a power law, and there are nonlinear phase shifts in markets that really happen. Another lesson of the last decade has been the emergence of network effects. We saw that with companies like Google and Facebook, and we may have seen it with the emergence of things like Bitcoin. And so Peter Thiel's framework is pretty interesting. I'd encourage you to read his book, 0 to 1. It's a very good book. And then, like a final sort of couple of lessons I'd sort of share is that policy can be more irrational than you can imagine. And I think you only just have to think back to the last year of COVID. We probably were more draconian in terms of lockdowns than we may have needed to be. And in terms of the impact on the real economy. And then we probably stimulated more than we needed to stimulate. And that's going to create problems in the coming years. And, sometimes one final sort of lesson, I'd sort of share is, I remember being in Buenos Aires before an Argentinian election, and I got to meet the candidate who became the president of Argentina. And he was preaching sound policy, and he was a market darling and a favorite. And we didn't invest, but many hedge funds sort of piled in given the high interest rates in Argentina. And there was an interesting nonlinear tipping point moment where the economy was struggling to adjust, and they were doing the equivalent of quantitative easing and easy fiscal policy. But they kind of got behind the curve expectationally, and then the currency started to weaken dramatically, and that fed through to higher inflation, and then it just fed on itself. And so when currencies go, they can go quickly. And so that's it's studying Argentina, you learn a lot about financial crises.
Yeah, that's a really great lesson. Thank you for that. And what are some permanent changes in the economy that you believe will result from this pandemic?
There's some bad changes, and I think there are some good changes. Let me start with the bad news and then give you some good news. I think on the bad news side, I think what we're going to unfortunately figure out in the coming years is that there's a path dependency to fiscal policy. It was understandable that when the unemployment rate was gapping up to 14%, that we put in place emergency stimulus measures and that we ran a 15% deficit. It was an unprecedented shock to the economy, and we responded in an unprecedented way. I think the mistake that's been made here, that's going to be with us for some time, is that we kept policy easy this year, even after business confidence recovered, even after the level of earnings on the S&P 500 has reached a new annualized peak level from the first quarter, even after we're seeing a return to positive inflation. And the problem with that is that once you put in place programs, there's an asymmetry. It's easier to put them in place than it is to unwind them. One, because people don't like to lose new benefits that they're getting. Most emergency powers that are conferred almost never go away. And so there's a kind of autocorrelation of policy. It's sort of a kind of a Weberian view of the bureaucracy, if you will. But I think it's going to prove hard to consolidate fiscal policy. And we're going to, even though deficits will be very large, they may be smaller in coming years, and then that could risk tipping the economy into recession. And then we're going to have challenges adjusting back to more normal fiscal deficits, I think. And as the government has grown its share of the economy, and as services have grown their share of the economy, the structural rate of productivity growth has gone down, not up. And so it's going to make it harder for us to normalize fiscal policy. So I think that's I think we've got ourselves in a fiscal pickle, basically, that's going to be with us for a long period of time. On the positive side, the vaccine story was an enormous success. And I think the mRNA technology is groundbreaking, and it's going to be with us for a long time. And it may enable us to solve a whole host of other health issues. And so necessity is often the mother of invention. And I think we've proven out this technology. We hope, we'll wait and see the longer term effects of this new technology. But so far it looks pretty good, and that could be a positive game changer for public health.
Yeah, thank you so much for those insights, Mr. McLennan. And for a concluding question, what qualities, background, and experiences are you looking for in college students who dream of one day interning at First Eagle Investment Management? Well,
I think natural curiosity is at the top of my need hierarchy. I love people who are compulsive learners and who are interested by sort of what I have heard sort of coined the term sort of consilience, a multidisciplinary approach to thinking about problems or solving problems. So curiosity is critical because we're basically in the business of being professional learners. And I think the second thing, and it's a corollary of that, is that we really look for people who are self-directed, sort of self-starters, who have a little bit of fire in the belly and gumption and some polite hustle, if you will. You see it when you get to know people. Like sometimes people do what they do in life because other people think it's a good thing for them to do. Other people are motivated from an inner kernel. And we like that kind of inner kernel of motivation. I think it goes without saying, we care a lot about people being ethical, broad-minded and good citizens. It's not just about aptitude, it's about attitude. That matters a lot. And I think in respect of that, we obviously love seeing evidence of success, but we also like to see people who've adapted to failure and studied and learned from their failure and that have a resilience and an ability to kind of view failure as a learning opportunity rather than as a setback. And the final thing, and I think it's linked to that, is that we like people who like to work at problems over time rather than just sort of complaining about problems. And so so I think those are some sort of softer attributes apart from the kind of analytical toolkit.
Yeah, thank you so much for that, Mr. McLennan. The session was extremely valuable, and I really appreciate you taking the time out of your busy schedule to join us today.
It was a pleasure, and thank you for the challenging and thoughtful questions. It really was. It was great to get that list of questions, and I wish you all well in your investing careers.
Excellent. Thank you so much. Have a great day.
Thank you.